Hello and welcome to Fathom Live, a live stream show dedicated to giving you tips and insights from experts in and around the real estate industry. I am your host, Jeff Sturt. So glad to be with you here today. We have kind of a different format. This is not our regular Fathom Live. This is a special live stream that we're doing to try to bring some pertinent information to you during this coronavirus pandemic. So I'm pleased to be bringing on Parkmont Lending. We have Wendy Forsythe waiting in the wings as well here. And this is the first time we've done a live stream with 4 different people from 4 different locations as we're all quarantining here. So, and the fact that we're spread out. So I'm going to ask for forgiveness right off the bat here because I'm going to have to sort of navigate some things to bring people on the screen here. So to begin with here, I am going to, that's Jim, here's Sean. Sean, why don't you tell us a little bit about who you guys are, and then we'll get things started.
Absolutely. Hopefully everybody's doing fantastic, considering the times that we're having. But I'm with Parkmont Lending, Jim Reed's Parkmont Lending. I'm the Executive Vice President, Parkmont. Jim is Regional Manager. We're going to be diving in and kind of giving some clarity on what's going on in the mortgage business and specifically with loans and what do we see in the future, things like that. Before we dive in, I just wanted to kind of give a little bit of background on Parkmont, just so you know the size of the organization, that the challenges that we're having to overcome. We're not a small mom and pop organization. We have to dive very deep into the challenges that everybody's facing right now, and I think that gives us great value out in the marketplace. But just to give you a quick background on it, this month alone, between Parkmont and AFN, who American Foundation Network is our parent company, we'll probably fund over $1 billion. We're already at 650 units for the month of $120 million. We have about 45 to 50 correspondent lenders. We did have about 20 non-QM lenders. We'll talk about non-QM here in a little bit, but we did have a good portfolio of non-QM lenders. So we're a very sizable organization. Actually, we're the 6th largest non-banking lending institution in the country. So we'll probably end up anywhere around $12 to $13 billion in 2020. So I just want to kind of give you guys a little size to show you that we have to dive deep into the issues that are happening, and we have to create things, be fluid with challenges and how to overcome them. Because you know what, we got to keep pushing forward, right? You know, we don't want to climb down the fetal position. We got to handle this, and we got to jump in, and we'll push through this together. And I hope today adds clarity. We've got a lot of great questions, and with that, start moving forward.
All right. Thank you, Sean, so much. I got a comment here, and it said that there was no sound. Can you all, the viewing audience, confirm for me that you can hear both me and our Skype guests? Can you do that for me? We just want to make sure that we aren't doing a show that you can't hear, because that wouldn't really be helpful.
That was the best speech I've ever done. Nobody heard it?
All right. It looks like I got sound now. Let me just make sure. Yes. Okay. All right. They can hear us now. I'm going to jump over to Wendy here. Wendy is going to sort of drive today. She's going to really bring to the fore here what's going on in the industry and ping things off of Sean and Jim. Now, if you do have questions during the show, feel free to ask them. We're going to be monitoring as best as we can. We already got a lot of stuff submitted prior to the show, so thank you for that. But we will continue to field questions as we're able to do. So here's everybody. I got everybody on the screen now. So Wendy, why don't you kick things off then?
Thanks, Jeff, and Sean and Jim, thanks for taking the time to join us today. I know that you guys have a lot going on in your world. So we just want to give everyone a rapid fire. We're going to try to keep this around 30 minutes for the viewers that are watching on what are the topics that we should know about that are happening, that are impacting our sellers and our buyers in the market right now, and just some general overview on your guidance on, sort of this situation and how it's impacting financing. So let's start with mortgage rates. So, up until about 6 weeks ago, kind of one of the bright lights that we were all very happy about was, lowest rates in history. So tell us a little bit about what your thoughts are now about rates as we move forward, and would love to hear in layman's terms, for all of us realtors out there, that connection between what the Fed is doing around Fed rates and how that impacts mortgage rates.
Okay. So to answer the first part of the question about like mortgaging interest rates, there's two factors that we have to deal with, and they're absolutely separate. And one is going to be the way the market is actually running. Right now, it's very volatile. It's going up, going down. We're seeing, the Dow Jones jumping 1,000 points a day, whether it be up or down. So that market instability has really caused rates to kind of go up in one day, down in the next, and it's very difficult for anybody to kind of place any historical models on it because it's not acting the way anybody's seen before. And that's really what the interest rates are going to be kind of going off of. But as we're starting to see some more stability as we move on, those interest rates will probably remain at a record low because we're still seeing very low interest rates. I mean, we're quoting rates in the threes still. Now, granted, is it 3.25 like it was a couple of weeks ago? No, it's probably more like 3.5, 3.75 for a perfect borrower, of course. So we're still seeing record low interest rates. But then the other piece of that pie is on the government loans. Because of the potential furloughs and stuff like that, we're seeing a cost for the rate. And now normally what we look at is we look at an interest rate and we call it a par rate, where it means like that's the interest rate with no additional fee. Government loans right now, they do not have a par rate. They're really for the perfect, 780 credit score borrower. You're looking at a VA or an FHA or a USDA loan that could still be in the threes, but it's coming with a 2 or 3, or in some cases, like I priced one this morning, a 6-point price.
Wow.
And that is the lowest price available. And the reason why they're doing that is just for fear of the first payment defaults. They're making sure that people can afford to pay these back. So there's two separate things there. Interest rates, you can watch your 10-year treasury and your stock market to kind of see what they're doing there. Really, on the government loans, we're going to have to wait until everybody goes back to work and that stabilizes before we see those prices come down. So two different things, pricing versus rate. And so that's how that's working. As far as the Fed, when the Fed says that they're going to take their short-term interest rates to zero, a 30-year mortgage is not a short-term loan. They're talking about if you're going to get a signature loan from the bank, or you're buying a car, your credit cards that are on variable interest rates. Those you're going to see lower. Like one of my credit cards I looked at the other day, I think I'm getting like a 9% interest rate, which is really good for a credit card. But it's only the Fed's affecting that. So think 5 years and shorter for the Fed's low interest rate. What they're helping there, they've actually not done anything that I have seen to the actual mortgage rates like they used to. They are buying more mortgage-backed securities, though. I think yesterday they bought it. $22 billion, which that brings us back to 2010, 2011, where they were buying a large market share of the mortgage-backed securities, and that's helping keep the interest rates stable.
Okay. So can I just unpack a couple things that you said there? So let's go back to points for a second. So I might get my 3.75, rate, but I might have to pay up to 6 points, 4, 6, it's going to vary. So that literally means thousands of dollars that I'm going to have in hand on closing day in order to close the property that probably I may not have been expecting to have that much.
Correct.
Okay, so that's important for us to understand.
And that's industry-wide. Like it's very important to understand that, because I'm fielding calls all day. This lender I spoke to out there, they want 3 points to get a VA loan. That's ridiculous. What can you guys do? Unfortunately, all the money is coming from the same place, Fannie, Freddie, or Ginnie.
Okay. And I want to dive into sort of the different loan products and the changes we're seeing there. But the other thing that you said was furloughing, and we're seeing that happening. We're also hearing a term now, forbearance. And so tell us what those terms mean to borrowers out in the market.
John, you want that one?
Yeah, no, absolutely. The forbearance right now is a big thing. It's a word that's being thrown around too much, actually, because people are assuming forbearance means forgiveness, and that's not what it means. There are a lot of options when it comes to forbearance, and what we're seeing typically, and just know this, forbearance comes down to the individual servicer that they kind of, right now they're dictating their rules on what they can do and what they're willing to do. We have some that we see that are 3 months, 6 months, 12 months. Let's just use a 3-month example. So if you call and say, hey, I'd like to take advantage of a 3-month forbearance. Well, if you've got a payment of $2,000 and you're going to miss the next 3, so forbearance is just pushing it from today to 3 months from now. So you will have a $6,000 payment to catch back up for the 3 months you just skipped out on, plus your current month. So you're going to have $8,000 in payments due. So forbearance is really, in my opinion, it's not a great option for everybody. It can work for some people, but you really need to think about that. Right now, the rule is they can't, they will not, well, I should say they can't, they shouldn't be hitting your credit scores for forbearance. So if you are missing payments, as long as you worked it out with your servicer, that is okay. They're not going to report that to your credit reports. Now, if at the end of your forbearance, you don't make that $6,000 payment or that $8,000 all-in payment, then they can start hitting you with 30-day late, or if you don't make any of it, guess what they're going to do? They're going to push it back and start hitting you with 120-day late. So forbearance is you got to really make sure that you understand it. You've got to get with the servicers, contact them, because your mom may have done forbearance, but I can't get the same deal with my mom. I have a different service provider, so you can't be talking to your neighbors and go, well, they got a 12-month. Okay, no, it's up to each individual today. Now, the government may step in and say, hey, we want to kind of create some consistency with this. They'll have to step in with also some additional funds and easing for those service providers, because these are third-party independent companies. And a lot of people don't realize 40% of the loans that are serviced out there are by non-banking institution, meaning it's not Wells and Chase and all those that are servicing them. It's a true third-party servicer on it. So when you do a forbearance, those third-party servicers still have to honor the contracts they have with these other investors and hedge funds. So, and this is why when we talk about FHA, VA, the government loan specifically, this is why those points are so important. Because if you're under a FHA or VA loan now and you don't make your payment, that third-party servicer still has to pay the hedge funds and the mortgage-backed securities with the investors. And so it's using their capital to do so, but they're not getting the payments. On conventional, they don't have to. Part of the contract is they don't have to pay those investors. So if they're not getting paid, you don't get paid on the conventional. But the govies are guaranteed. So that's where liquidity is very scarce right now for these third-party servicers. Not to dive in, but Jeannie Mae is trying to help them. They've actually created a plan to try to make whole these third-party servicers. But unfortunately today, Fannie and Freddie said they will not do it. Fannie and Freddie's putting some pressure, and it's going to go back to the government to try to help probably another bailout of some sort. So it's really interesting times right now for those third-party servicers. Forbearance is a big part of it.
Okay, so the advice then to the borrower is to talk to your servicer, make sure you understand really what you're doing in terms of timing, and get really clear on that before you decide that that's the option that might be, work for you at this point.
Yeah, absolutely.
We have
Watch forbearance.
Oh, I'm sorry. Go ahead and finish, Sean. We have a follow-up question to Jim's section back there.
I was just saying, make sure you're speaking clearly with your servicer. Talk about forbearance. You might hear words like loan modification. These are very dangerous words. You've got to understand how this is going to impact you when it comes to your credit. Modification and forbearance are two totally different animals. So just talk through it with your servicer. And then, look, I would offer our services. If any of your clients have any questions and really don't know what it means, talk to us. We can help guide you through that. I mean, that's just something we should be doing to help people.
Quick follow-up question from Ray Hustek. He says, how do we handle skeptics who say if Fed rate went up, you can be sure mortgage rates would rise? Some people think the lenders are just taking advantage of the situation. So I don't know if that's for Jim or who wants to take that one.
No, that's fair enough. Unfortunately, we deal with that as part of our day-to-day. Every time somebody calls me up and asks me for an interest rate, they're like, well, that seems high because I saw on Facebook it was 2.1. Okay. There's a lot of misinformation that's going to be on the on the internet, and they're going to be able to come out of that. The unfortunate thing is that obviously for the realtors that are on the call, make sure you're talking to the loan officer that you trust. You know, like, are they actually going to be able to speak to this to your clients? Because I just got a call the other day from a realtor, and she goes, this loan officer didn't even know anything about it. Well, that's a red flag to me, because it's happening industry-wide. So most likely your clients will be hit with it. The best thing I can do for them is I can actually provide them with a few articles and a few different things to show that that's happening, and just basically have full disclosure and just try to educate. But we're finding that, unfortunately, because we're not educating the realtors, which is, I think, great about this call, is when that client comes back to you and says, that lender you referred me to said 2 or 3 points, we probably need to buffer that by giving them that heads up before they even go into it, because that was not there 2 weeks ago.
Right. Okay. So our time is going rapid fire together. So let's jump into mortgage products, because we've seen a lot of change in what's happening with, FHA loans, jumbo loans, non-QM loans. So give us the bullet points on what we need to know about what product changes are happening out in the market.
Let me jump on this, Jim.
Sure.
Awesome. All right, and I'll try not to go so long with it. Sorry, Wendy. Real quick, we'll try to keep it at a high level. But about 2 weeks ago, everybody hears the word, the term non-QM. Non-QM did shut down about 2 weeks ago. What does that mean? That means that's going to be your bank statement products, your no income verification products. They call them NEVAs and SEVAs. All those niche products, they're gone. Okay, they're going to be put on the shelf for a little while. And then, so that was about 2 weeks ago. A week after that, then you hear the big buzz of non-conforming and jumbo. All right, that was a big buzz that hit last week. That's another one that's being shelved right now. Non-conforming is, for this area right here, it's 510 or greater. It's going to go based on the county loan limits. It's different in California. It's different across the United States. But for us in Texas, in this area, it's 510. So anything above 510 is considered non-conforming or jumbo. That, unfortunately, has been kind of shelved to the side, and that it will come back. It's just, it's definitely it's slowed down quite a bit. Actually, there's not really any options for that today. Things you should watch out for in the future, and this is just an opinion of myself and Jim, is what's next. Next is going to be your DPA programs. We've already seen a good chunk of them shut down and stop lending. There are some that are still doing it. We actually just closed a couple this week. But the DPAs, in my opinion, is what's next. The DPAs, 203Ks, your rehab loans, your home readies, that is going to be the next product that, if we continue to go down this path, your conventional, your FHA, your VA, your USDA is what I see on the horizon. Now, I can dive in real quick if you want on credit scores and things like that.
Yeah, let's talk about credit scores. So
okay?
Tell us about credit scores, and also tell us that if you're laid off, just for like a short period of time right now, will that impact your credit score?
Absolutely. So I'll run through the credit scores, and I'll let Jim answer that secondary question. When the crisis kind of hit 2 weeks ago, and you saw a lot of things shutting down, you saw a quick reaction by a lot of investors, and investors jumped up to, a lot of them you saw jump up to 680. They went from 580 to 680. Boom, we got to stop the bleeding, figure out what's going on. So believe it or not, in the last week, it actually has loosened up, which we're excited to see. But they just had to understand the market and understand what's going on. Everything's about stability, predictability. And so when we see the market stabilize and investors have that ability to have, predictability and understand that maybe we're seeing a good solid foothold in the market, consumer confidence, investor confidence, things like that. It allows them to, go back and analyze. So what we've seen now is, and I'm going to speak specifically, this is going to be Parkmont related, right? Because every investor has their own options. Now we have 45 different investors. We typically all playing in the same pool, but some could vary. But for us, we were at 580 before. We've gone to a minimum FICO score of 620. So our basic product went from 580 to 620. Where your traditional stuff's going to be at 660. 660 is kind of the sweet spot for everything right now. If you go below 660, these are some of the quick and dirty requirements that you're going to need to see on it. If you're at 620 and you're going to need a 620 with a DTI of 43%. If you're going to be a 620 and you need higher than 43% on your debt to income ratio, you're going to start needing to have common sense things like some reserves, some rainy day money. And so what they've done is they've come back and said 620, greater than 43% DTI, they want 3 months reserves. And so that'll get you all the way up to 50, and you got to have a approval, DU approval with Fannie Freddie approval. That'll get you up to 50%. Now, you have some cases that client might be at a 52 or 55, just maybe stretching it a little bit more than the market wants, but it's okay. The guidelines are there. If you're going to be at a 52 to a 53% debt to income ratio, then you just do your 620, but 6 months reserves have to be in the bank. And these have to be your own funds. You can't go out and do gift funds for any of these reserves. The reserves have to be your own money. So basically, 620 to 660 is still open. I know a lot of investors aren't. There's a lot of them that are 680, 660 and above, and that's it. There are 620, but it just comes with some common sense stuff to help protect the investors and the market at the end of the day.
Okay. So Charles Jones asked us a question, and it sounds like you're answering it, but his question was really straightforward, and it was, is it going to be easier or harder to get a mortgage?
Harder.
Yeah, it's that you answered that one. Yeah, to call that out for sure. So, Jim, tell us about how we protect our credit score during these times. So, a lot of people are asking, I'm getting laid off from work. It's a short term. It might be for a month or two. What should I be thinking about in terms of protecting my credit score and making sure that maybe down the road I can still be eligible for a mortgage?
Sure. So, and that goes to the whole, can we get a mortgage if I've been furloughed? And so I'll start with that. And at the end of the day, we all, whether you're a loan officer or a realtor, we have a fiscal responsibility to the client. We also have an emotional responsibility to the client as well, but unfortunately, this comes off kind of callous. If they're furloughed, they're actually unemployed. And putting them into a fresh mortgage today as they just embarked onto an unknown length of unemployment is fiscally dangerous. And that's one of the reasons why we ended up with our crash of 2008. And the fact that the government and the investors are all saying, hey, we're going to be responsible and we're going to put some things in place to protect ourselves against ourselves. It might sound callous. It might sound, because I've heard the term it wasn't their fault. Well, no, it's not. Of course it's not. But then again, not every loss of job is their fault. And if we were saying, hey, well, let's go ahead and give the unemployed person the mortgage, we put them in a tough spot. And then to move on to that, that's also protecting their credit score. One of the things that Sean had said was reach out to your service provider. Well, forbearances are not going to be automatic. If you it's free, no, you don't. You actually have to get that put in place. So you have to reach out to your service provider. If you're having trouble with your car note, reach out to the banks there. I know that some of Wells Fargo Auto sent me an email the other day saying that they are doing some things to help you, but you got to reach out to your banking institutions and get permission to pay less or pay nothing. And then understand exactly what that's going to mean when the forbearance is over. Are they going to roll that into the end of my loan, like on my car loan? I think what they're doing now is they're saying, okay, take 2 months off, and then we'll tack it on to the end of the car loan. Or are they doing it like mortgages, where after the end of 3 months, you owe 4 payments? You have to understand that. So it's going to be about communicating with who's extending debt to you.
Right.
And then really the other part of that is we advise them that if you're being furloughed, this is not the time to be overspending. You've got to tighten the belts because we don't know how long that's going to last.
Right.
Yeah, communicate.
So Dixie Lyon submitted a question, and she was asking, do we see that, or do we think that we might see more short sales? Are we thinking this is like the beginning of another sort of REO chapter that, we might all be, having to deal with?
I'll jump in here.
Okay.
Do we see that this is going to be something like a business opportunity long term? I don't think so. What you have to remember is before we went into this crisis or this crash, fundamentally this country was in great shape, right? And so we had a virus that spread out very quickly, put a lot of fear out there, a lot of emotions going through it. We had to figure out how to react to it. That's why you see this market responding so well. Everybody's expecting a V bounce on it, which the market is showing that, right? We were just down to just almost at 19,000 last week. Here we are at 22.5, or I just looked at a little while ago. So fundamentally, this country's still sound. And so that's why I feel like we will bounce back and bounce back relatively quick. We shouldn't have challenges that we saw that lingered for years in the crash 2008. So I don't think there's going to be the opportunity for the short sale business. Will we see some? Absolutely. Statistically, just so you know, 3.5% to 4% of all loans right now are in forbearance. All right. Now that number is a lot less than they were anticipating. They were literally anticipating double digits on it. So it's a good sign at only 3 to 4. I hope it's because the educational process is happening on it, because it's not a great option. It's an option for those that really need it, and that's what it's there for. But if we can maintain and keep that in control, then that's great. Real funny, when I say we collectively in the mortgage industry, there are clients closing on a loan, and then within a week they're contacting their servicer saying, I'd like to go ahead and miss the next 3 to 5 months payments. To me, that's just not right. You shouldn't be closing on a loan, right? You should be rethinking where you stand and am I sound financially? So that forbearance stuff, we've got to watch very, very closely. I hope that we don't have a country that takes advantage of the situation, because it could not to be it could take us to the next level, right? So we've got to be careful. Let's help one another and advise one another properly and help push through this together.
All right. Good advice. Good advice. So you guys are always a tremendous resource for all of us here at Fathom and for all of your clients in general. Jeff, do we have any final questions that came in while we were just chatting?
Yeah, there were a couple, 4 different ones but two of each were sort of related. The one question came in from Vicky Manna. She said, "Are you saying jumbo loans are no longer an option? If that's the case, then what do buyers do in that market? What do buyers in that market need to know and do?"
So it's not gone completely, but it is nearly gone.
Really close.
Yeah,
really close.
You may find an investor or two out there that are still doing them. Now, we have like one non-conforming investor that's still open for business, but before I even tell them about it, I let them know you're not going to like it.
Right. The rates are going to be higher, right?
It was 6.5%.
Your rates and your points. Yeah. And we
806
heard
credit
last week
score,
that
6.5%.
Wow. And Wells just totally cut it off altogether, right?
Chase,
so,
your big jumbo investors are gone, or not gone. Shelved is a good word for it. It's on pause. And the biggest reason is I don't want to tie up $1 million of money. Not me personally. I'm not that kind of guy. But Chase, they don't want to tie up $1 million before they even get funded. Have already lost 40 grand. Because the market's shifting way too much. It's too unstable. They don't even know how to price it. So they figured, you know what? We're just not going to do it because it's not going to create anything that's profitability. And the only reason why they're doing it is to make money.
Mm-hmm. So definitely impacts that high-end luxury market. So those of us that are in those sorts of markets, like, this is important information. But keep in mind that cash is always king, right? So
always king.
Right. So you can always bring more stuff to the table if you want to get that home. But if you don't have that, you're going to have to.
And that was the option I was going to do for those that are less than $1 million. You could look at going back to doing the first and the second lien. And that way that first lien falls into your conforming. Mm-hmm. And then if you were going to bring 20% down anyway, like the one I just set up yesterday, they had to bring an extra 17 grand to closing, but it was all equity. Like, it was just extra down payment. So it wasn't like it was a fee. It was just now that they have more equity in their home and they were able to get regular conforming at a decent rate.
So my advice to our agents would be talk to a great lender that has some options available, that has sound advice, And don't get too caught up in the headline that, jumbo loans have been shelved or gone away. This is a time more than ever where we have to work with our clients. We have to work with our business partners like you guys to find solutions for our buyers and our sellers out there.
Yep. You may have already answered this, Jim, but Desiree asked, have VA jumbo loans also been shelved?
No. VA loans are still operating just the way they were. We've just actually closed a couple this week already that were above the county loan limits. So it's falling under the agency guidelines. So as long as the VA is still alive and well, so you're fine there. But you will pay probably 2.5 to 3 points on the front of that. So you do the math on 3 points on a $800,000 loan. Pretty steep.
Pretty expensive.
Yeah, and if I could add there, I think the point is something where I think a lot of people get surprised. They go online, they find the mortgage calculators, they type in, 3.5%, 3.75, their loan amount. They see a monthly payment where they're like, great, like that's awesome. Then they talk to you guys, and I can imagine those conversations once they find out, what it's really going to cost them, and that changes things substantially. So important for us as agents when we're qualifying buyers and working with our buyers that we are knowledgeable around sort of the cost of the loan.
Well, and that brings me to, as far as information for the agents, be aware Facebook is not the best way to find answers. Now.
Unless you're watching our Facebook Live.
Oh yeah, except for this one, of course, right?
Yeah.
But the reason why I say that is if you ask enough loan officers right now, you will find one that says, yes, I can give you a jumbo rate, and it'll be a great one. Or I have VA loans with no fees. You're going to find somebody to give you the answer you want. The problem is that I'm fielding the calls the day of closing because the funding's not coming.
Right.
Somebody had told them at another mortgage company, this loan officer told them we're good to go, but then he was hoping that it would be over by now.
Right. Yeah.
So be more mindful of that.
There are questions pouring in here. I don't know if you guys have
questions
time.
Pouring in.
Take some more.
Okay,
go ahead.
I was going to say, yeah.
All right, let's do it.
Questions are pouring in. Are you guys good to stay for a few more minutes?
Absolutely.
Okay. Cool.
Okay.
Can't go anywhere.
Yeah, that's right.
True.
We're all here. We're all in our homes. So one question: can individuals use? And I'm paraphrasing because I'm trying to find it. Can individuals use the money that's coming in from the government to them as part of their qualifying? I guess can the borrowers use income from the government during this crisis?
Depends on how they're getting it. If
maybe perhaps the checks that are being written to everybody here with the crisis stimulus.
Well, the $1,200 check, if that's what they're talking about, that government check, it's not a loan. It's no different than a tax refund.
Hopefully it doesn't continue.
What's that?
Hopefully it doesn't continue, right?
Well, exactly. $2.2 trillion is not sustainable as far as government bailouts. But to answer the question, I would say that kind of money, that $1,200 check, that's sourced, and we know where it came from, and it's not paid. You don't have to pay it back. If you're doing a
down payment, not income related. Down payment related, yes, but not income related.
Not income.
Right. Yeah, it's not going to be considered income. If they're taking out a small business loan, and I don't want to touch on that, I know, Wendy, but at the end of the day, if that's what they're doing in order to augment their income to make it work, no, that's not going to fly.
Yeah, and for our viewers, in our prep call, we had talked about staying away from kind of the CARES Act, and we know there's a lot of questions about that, but that's not, Jim and Sean's area of expertise.
Right.
Can you share with us if you're doing anything or requiring anything extra in terms of employment verification letters? Like, I've heard that some lenders are asking for employers to provide a letter saying that I won't be laid off. So not just verifying my employment today, but saying, and I won't be laid off or furloughed or terminated or, anything else in the future.
Yeah, it's going to be the the language on that's going to be very specific, right? You can't say they won't be laid off because no employer is ever going to give you that. But they don't anticipate laying them off. They foresee any future changes. Verifications, just so you guys are aware, I mean, we do a lot, obviously written verifications, but the warehouse lines, they also require verifications typically within 24 hours to 48 hours of the closing. And then now what's happening is before the loan, so we fund the loan, and then within 10 days, 15 days, we're selling it off to the servicer. What's happening now is those servicers are asking for another. They actually don't even ask for it. They go and do a verification. And what happens is if that person has lost their job by the time they buy it, they come back to us and say, we're not taking a loan. And then lenders get hit with, we call them repurchases. We have to turn around and sell them on a scratch and dent, and you only get 70 cents, 80 cents on the dollar. So that's where it's really dangerous right now for these large organizations, is that third extra check for verification of employment in that next 10 to 15 days. We don't have any control over that, right? Company lays them off or furloughed or what have you, but we're financially liable for it, and we have to accept that. But yes, there are more checks and balances with it.
There's a question here as well about timing. Somebody asked, what if you have a client closing in just a few weeks?
As far as verifications?
I think she was asking about like jumbo loans and those sorts of things. If if they're buying a house that's in that price range, maybe if they've already started the process and have been pre-approved, does that sort of lock you in?
No, unfortunately, that's where a lot of heartache comes from. Back when the crash happened, you had organizations that would just shut the doors. They didn't care. You had people that go and sign for the closing, and funding never showed up. They just don't care. Unfortunately, a lot of that's happened now is once they took the programs away, the non-QM was like that. They didn't care. They didn't care if they had locks. They weren't going to honor them. They shut them down and they stopped. So
you could have a closing Friday and think that you had everything in place, and it's not going to fund on Friday. So for our agents that are in that, like, you need to be having very proactive, consistent, constant conversations right now.
Yeah.
Don't assume because it was that you got a letter a week ago saying that financing was okay and you removed contingencies that it's going to fund and close as expected.
And to use J.R. Russell's advice here, he loves the use of a leaseback, because what that allows you to do is not have a moving truck at title. Because if for some reason there's an unforeseen delay, you didn't just sell your old house and now have no place to live because the funding didn't come.
Good point.
But if you were trying to coordinate that where today's the day I'm buying the house, that's funding's going to come and I'm homeless if I don't move in, that leaseback will protect you. Now, obviously, I'm not saying have a move in before funding. No, don't do that. But if you have the leaseback in place, that means they can maybe move after funding because they have that built in. So that's just something that JR obviously recommends as well.
Good advice.
I've got a couple more.
All right.
Laura asks, did you say that conventional loans will be paying points as well?
Not right now. No. Conventional loans, because of how it's working with the third-party servicers, everything's about risk and reward, risk and fear and market, stuff like that. Conventional right now is still on pace and on par. They're well performing, and you can get a par rate. That's just more dictated by your credit score, the type of down payment you're putting down, things like that. But conventional is still okay.
Yep. Some other guy named JR just commented, "Genius, leaseback protects all parties." His last name happens to be Russell as well. Several questions kind of were scattered through here about student loans. How are student loans affecting borrowers? I don't know if you can speak to that.
There has been no change to that policy. So, if they're conventional, it's whatever shows up on their credit report as far as their payments. FHA, it's going to be a amortized total of 1% or the fully amortized, even if they're in forbearance. And VA, it's whatever's showing up on their credit score. So that hasn't changed at all.
Okay, great. Go ahead.
I just want to jump out here because I think I've seen questions. I know we've had it on some other calls that we've done in the past. On the forbearance, I've had a lot of agents ask, can a client sell a home that's in forbearance? And the answer is absolutely yes. All right. You could actually refinance it. You just can't be in forbearance. So you have to make whole a forbearance. So when you're selling a house and you're trying to list a house, you probably should be asking them if they are in forbearance, because you probably do a net sheet and you got to figure out what they're going to walk away with. So you could have those conversations that they do absolutely have to make whole when they sell that property if they are in forbearance. That comes up a lot of questions.
All right, we got a question that came in, the same question from two different people, one on Facebook, one on YouTube, the exact same question. Shouldn't we really be worried about appraisals and letting our buyers know that the value today might not be there 30 to 90 days plus from now? Similar question over here on YouTube as well.
I can do that one. Just like Sean had said, I do believe that because this is going to be a fairly short period of time and a blip, 30 days from now, if you're buying a house today for $200,000 and in 30 days there's been a little bit higher uptick or a little bit more difficulty selling houses, yes, the appraiser may see that that's warrants less value 30 days from now. But as soon as we're all out back and everything's back to normal, that appraisal is going to go back up. So as long as we don't put ourselves in a position like we were in 2008 where everybody's foreclosing, I don't foresee the home values doing much more than just taking a small dip over a 3-month period. But if you're going to be in a house for 3 or 5 years, you're not going to really be concerned with that. Personal opinion, by the way. I'm not an appraiser.
Yeah, I mean, I can share from a field story. An agent in Northern California, just outside of San Francisco, that I talked to last week, had 2 appraisals come back fine. And so we haven't been hearing many concerns across the country, even in, the early impacted markets like the greater San Francisco area. So fingers crossed that, home values stay steady, which everybody feels they will.
Yeah. I've seen no statistical difference.
I think that's most of the questions. There was one, and I'm not sure what it was related to. Do the reserves have to be seasoned money? I'm not sure if that was to something earlier that we were talking about.
Yeah, when Sean said it has to be your own money, basically that's exactly what he's talking about. We have to know where it came from, and so it either has to be seasoned for them to be able to use it, or we have to be able to source where it came from. So if it was like a tax refund check, we're good there. It doesn't have to be seasoned because we can source it. But it has to be their own money.
2 months. Season means it has to be in their bank account for 2 months. When we say the word season, that's what it typically means.
All right. Well, gentlemen, this has been very educational. So we thought we were going to be 30 minutes, and here we are. So thank you, everybody that tuned in, for all of your questions. And we so appreciate your knowledge and support. And I'll leave the final word to Jeff and to you guys.
All right, guys, thank you so much. So you can reach out. I'm pointing to them here on the screen. You can reach out to these two guys above me here. If you do have other questions, obviously you can see they're very, very helpful. And just some advice that we've heard on many different live shows going back is be the calm one in the room. And I think that applies to when you got to reach out to your clients and maybe deliver some not so great news or some stuff that, we're going to have to delay some things here or whatever it may be. Be that calm one in the room, be the adult in the room. So some good advice there. Any last words from our guys from Parkmont?
Mine is just like this information that I'm giving you is great today. Tomorrow, tune back in because I may have some updates.
Right.
It's changing.
Yep.
So educate yourself. Very good. Anything else? All right, guys. Thank you so much. And
stay positive, people. This is just
stay
going to
positive.
be
That's
a
right.
brief time in
but not
history.
positive.
Right.
Don't test positive.
Just stay positive.
Keep a good mindset.
Very
There
good.
you go. I like
Stay
that.
healthy.
Very good. And if you want to see some really good advice on that, go back to our last live show with Wendy, where, and I'm going to point over there. So with Wendy, she went through a lot of systems checklists and those sorts of things that you want to really put in place during this time and how to just keep plowing forward. Also, she did put out a video yesterday on some of the same kind of topics, the same idea about really being productive during this time on our Fathom Facebook page, so you can check that out as well. I'll let you guys go, and we'll kind of sign off here. But again, thank you guys for jumping in or for coming on today.
Thank you for having us.
But next week, we're going to be back to our regular schedule at 1:30 Central Time on this next Wednesday, and we have Diana Campos with us, and she's going to be talking about, as an individual agent, what she's doing now, and especially what she has done on social media that's really working, that has worked and will continue to work through this time, or should continue to work through this time. So tune in Wednesday at 1:30 Central Time for that show. We'll see you then.